Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Whilst I'll just let you have a look at the disclaimers, I'll just run through some of the key objectives of this webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. Okay, for this week, we'll go into our general format, which is to check out how markets are shaping up currently. We'll just take a step back, actually, and just have a sort of wider think about what we've seen over the last 10 days or so and potentially what that means going forward. We'll then look at US equities as we do and the major stock indices and some of the technicals around those. Before then, having a sort of deep dive into last week's main events, of course, the Fed, all those central banks, the Fed, the Bank of England, and the Bank of Japan, and we'll look at the DXY, so the dollar index, driving obviously FX markets at the moment. This huge, relentless rally that we're seeing, really impressive and coming on the back of or continuing really on the back of the hawkish Fed from last week. We'll look at that in detail. We'll look at Bank of England, as I say, and sterling against the dollar, which is continuing to drop today as well. And then we'll look at the Bank of Japan as well, and dollar yen, of course, well into intervention territory, just below 150. Then we'll just briefly check out a couple of the events of this week. They include the US PCE inflation data and as well a flash estimate of the Eurozone September inflation data, which are both released actually on Friday. So we'll look at those two key events for this week. In the meantime, just bear with me 1 second and I'll just grab the first couple of charts. In fact, I'll just show you first of all something we used previously, actually a couple of weeks ago, kind of portending what is happening at the moment. September, anybody who's been in these markets for a long time knows it is a bad month for risk markets, for stock markets especially, and you can see on this chart here just showing you it is the worst month for the S&P 500. This is the average monthly percentage change since 1928, so a pretty good guide. You can see generally you see a drop of over 1% in September, the worst month of the 12. Only two other months in negative territory, May and February. Interestingly, October always cited as a very bad month for stocks. Historically, probably not the case, but the fourth worst month of the year. So just bear that in mind. And then we have December and November generally quite positive, you can see there. Obviously no guide to what happens going forward, but just potentially interesting, and certainly September not proving so good for stocks at the moment. If you just bear with me 1 second, I'll just pull up our first chart, which will be the S&P 500 weekly chart that we generally look at. At the moment, though, risk is, well, European and US futures trading mix really pretty poor. Just checking US futures, actually, they're actually pointing upwards now, whereas European markets generally lower. That follows, of course, yesterday's US tech stock-led weakness, really, after consumer confidence dropped to a 4-month low, and also the expectations index fell below a level that in the past has signaled an incoming recession. The S&P 500 dropped to a June low as the Fed's higher for longer message that we'll talk about shortly really has driven US Treasury yields, with the 10-year Treasury yield that is really a global proxy for borrowing costs that hit a fresh 16-year high, while the dollar being driven by those rising yields that reached fresh year-to-date highs as well. Overnight equities in Hong Kong, they gained, with those on the mainland cooling after sharp gains earlier as China reported improved industrial profits, whilst crude oil remains elevated, adding to inflation concerns, of course, while gold now is trading below 1900 and on a key support level at 1894. In fact, I'll just touch on gold. We don't look at the chart that often, and we should do probably because it's a favorite trade for many people. You can see this is the daily chart. We were just oscillating around that black line, which is a 200-day moving average at 1927 now. You can see above it and below it. Now we're probably looking below it, especially after breaking that mid-September low at 1901 there. We're now at a sort of key fib level for us, which is this long-term retracement level at 38.2, fib level at 1894. You can see the September rally, and that is the 38.2 fib level. As I say, 1894 kind of tallies with this June low at 1893, and then also then you've got the mid-August lows just below there at around 1880 or so. So key support zone here for gold, you would think. Of course, rising yields, rising dollar really not helping the dollar, although gold, even though previously, apart from these this week really, before that we had seen, you know, even with the Fed decent performance in gold really, and we hadn't dropped that sharply over the last couple of weeks at least, even with the rising dollar. But obviously then, since we've hit those multi-year highs and that high year-to-date high in the dollar, then we have come off now, and this is a key support level for gold. I just wanted to step back, as I say, and just look firstly at just a sort of wider picture, really, just thinking about the last 10 days. The three major central banks have made policy decisions really that all seemed quite finely balanced, really, in that they could have gone either way. So the Fed, which we will look at in more detail, but that unanimously chose last week to hold its policy rate unchanged, but then it went out of its way to suggest that it may raise rates again at its next meeting. Contrast that with the Bank of England. They stayed its hand. The voting was split nearly down the middle. Observers, kind of us as well, increasingly thinking that the peak may have been reached. And then the previous week we had the ECB. They raised rates despite weakening economic growth. And it's this kind of deepening uncertainty around what monetary policymakers were going to do. Really is not hard to understand. It is linked to deepening doubt about what they sort of ought to do, really. And we've kind of entered now a period when the signals from both price movement and economic activity are becoming harder to read, and obviously with data dependent as well, and we've touched upon this, and that all increases the scope for error potentially. And the chance that the major central banks will then also diverge, so have differences really after what we've seen in the last year or so, which is kind of a synchronized tightening path of rate hikes. So just potentially this divergence theme is going to play out. We're seeing that already, of course, with this dollar rally and US exceptionalism. Basically, that kind of means growth and rates are, yes, exceptional compared to other areas in the world. So if you think of Europe, if you think of China, the UK certainly as well, seeing wide differences and not this resilience that we're seeing in US economic data. One other reason as well for the divergence, just getting slightly more technical into sort of more economics, is because of supply side drivers of inflation. So that's from, say, Russia's energy and commodity price wars to pandemic dislocations. They're kind of easing off now, but that means the main price risks are more domestic. And key really for central bankers going forward is potentially wage growth, which if it remains high, then could prevent services and then core inflation from following the headline rate down, and that's what we've been seeing. Okay, just always like to touch on the wider picture. Let's now look at equities. Yesterday they ended down over 1%. You can see the S&P finished down 1.4%. All S&P sectors were lower, and the drop was led by utilities, which declined more than 3%. S&P settled at 4273. The tech dominated Nasdaq. That finished down 1.51% at 14,500, just above, while the Dow posted its worst day since March. That ended down 1.14%, 33,618. It was actually the lowest close in the Nasdaq since late May, and actually the lowest closes in the Dow and the S&P since June. As I mentioned, we had weak data, so that worse than expected consumer confidence, as well as worse than expected new home sales, really hurt risk sentiment. And that follows on, of course, from last week. And you can see, if we just go to the weekly, you can see that big red candle closing on its lows and really pointing to more declines, which is what we're getting this week, of course. Last week, the S&P closed down 2.9% actually on the week, while the Nasdaq closed down 3.6%. Both indices now falling, you can see, for 3 weeks, consecutive weeks, and potentially a fourth consecutive week. We have to go back to the end of last year for 4 consecutive weeks of decline. So interesting price action here, really down to tech and mega cap tech stocks really struggling now in the face of these rising yields and higher borrowing costs. That is essentially the driver, because of course we've had the tech leadership, those handful of stocks, the Magnificent Seven, if you like, really driving the gains that we've seen this year. And now when those pull back, there isn't any other leadership really in stocks at the moment to take that on. And with those stocks declining, we're getting this downturn now in the indices. Right, just technicals then. This is the weekly chart. You can see we broke below 43.35, which is sort of near-term support, and now we have really this long-term trend line support coming up from the October lows, and you can see that is probably around, where are we, 42.30 or so. Just a bit higher probably. And then we also have then the 100-week moving average, that grey line, that's at 41.96. And that is potentially then just above that 50-week moving average at 41.56. Yeah, interesting really. We probably should put on some fib levels here. And if we just looked at it, just roughly say, I'd have to just pinpoint the exact high and the exact low. But just checking here, we're kind of now moving down to potentially as well, you can see the halfway point of this decline around 41.55, so around that 50-week moving average. Interesting there, potentially as support. A lot of lines on here, don't want to complicate it too much, but you can see that trend line support, the long-term trend line support that we highlighted, and then you've got this 200-day moving average, always widely followed indicator, just below 4,200. So around 4,200, and then above there 4,300, just above, actually 4,200, sorry, above there 4,230, 4,240, and then just below 4,200, that 200-day moving average. That's on the S&P 500. As for the Nasdaq, you can see now we are breaking now below that mid-August low. That's a 14,557. We've broken below there. That then with that close and closing on the lows on the week last week, but kind of hinted at more downside. We're getting that now, and especially if we've broken that mid-August low as well as that near-term fib level. Look on the daily. Yeah, breaking down through the 100-day moving average at 14,848. Then if we do move lower, we're not looking good until sort of 14,000 potentially, and you've got that fib level at 13,932. So the 200-day obviously way off at 13,500, just above there. So probably round numbers, 14,000 or so potentially the next level of support. in the Dow, in the Nasdaq, sorry, 100. Interesting for the Dow, we've been pointing out this this 34,281 level being resistance, then support, and now we've broken down through it, which isn't good. That will act as resistance now, and then you've got these two sort of 50-day, 50-week, 100-week moving averages, possibly near-term support. Really being that valid, really, you would think. So let's go to the daily. And we're just moving now through the 200-day moving average at 33,810. So potentially more downside to come. We're also now possibly breaking these June lows around 33,610. That will be next support. If we do lose those, then they're not looking so good, really. Possibly, yeah, we're going down towards sort of 33,000 as next level of support in the Dow. Okay, let's move on to last week's main events, of course, which was the Fed. Hopefully you can see that, which you can. Hopefully this graphic proves of use to you guys as well. Of course, last week, generally, that was a bumper week for financial markets, which had to contend with no less than 6 developed market central bank updates. Brief recap in line with expectations. We had, of course, the Fed and the Bank of Japan leaving interest rates unchanged. We had Sweden's Riksbank and the Norwegian Norges Bank. They both hiked rates. And the surprises really were then the SNB, so the Swiss National Bank, and the Bank of England, of course, both of which decided to leave rates unchanged as well, rather than to increase them, which was slightly more priced in by markets. As for the Fed, well, last Wednesday, of course, they maintained rates of 5.25% to 5.5% as widely anticipated. However, for markets, it was about the guidance on what was to come, which was key. Powell basically indicated the Fed had reached a point where it can proceed carefully in determining what rate will be restrictive enough to bring inflation back to target. But he said there is still more work to do. He delivered really a hawkish hold then, with clearly stronger than expected economic forecasts that marked a big surprise really for markets. So the Fed revised up this year's GDP forecast, as we've got here, to 2.1%, from 1% 2024 to 1.5% from 1.1%. And then 25-26 forecasts were left unchanged at 1.8%. Interestingly, the peak in the unemployment rate also was moved lower from 4.1% next year and the year after from 4.5%. But then, despite the stronger than forecast growth for measures or projections, inflation is still seen cooling, largely in line with earlier forecasts. So expected headline PCE inflation was slightly higher this year, 3.3 from 3.2%, unchanged next year at 2.5%, whilst core inflation was put slightly lower at 3.7% from 3.9%, and unchanged at 2.6% next year before returning to target in 2026. Basically, Powell made it clear that the more upbeat outlook warrants maintaining rates higher for longer. That is what we've been talking about for a long time. He maintained that, and that was certainly visible in the updated rate projections. So the dot plots, really key this. So 12 out of 19 Fed participants called for one more hike in 2023. That was pretty much nailed on, of course, and we had seen that in the previous updated dot plot from June. But then the 2024-2025 median dots were revised up by 50 basis points to 5.1% and to 4.6%. And that was basically where we saw 100 basis points of rate cuts in these dot plots. In the previous one in June, we now only see 50 basis points in 2024-2025. Certainly then a key factor driving the renewed hawkish reaction during the press conference was Powell also as well surprisingly open view regarding potentially the higher neutral rate. So while the longer term Fed funds rate estimate was unchanged at 2.5%, Powell basically mentioned that it does not necessarily suggest that the neutral rate could not be higher, which in turn would suggest monetary policy is not as restrictive as previously thought and will need to be going forward potentially if that long run rate, that neutral rate, is seen higher. All things to mull over, of course, the market reaction was big, certainly after the press conference. So bond yields, they've forced the break higher with maturities up to 10 years, basically jumping new cycle highs. The real yield, so that's a nominal, less inflation projections, that surpassed the 2% barrier. And then we had, of course, the dollar basically reversing the pre-Fed intraday dip, moving higher. Euro dollar dropped from sort of 107.30 down to close at 106.60, and now we're certainly we're around 100 basis points lower than that again. Dollar yen, that cleared the 148 big figure, of course, and now we're above 149. And really then a stronger dollar, higher real yields, and essentially the reinforcement of the higher for longer narrative around rates that then hurt equities, and it has continued to do so since sort of last week. Those were the main messages. I think one was, of course, for the Fed to engineer the hoped for soft landing that they really are looking out for. Governors see far less room to cut rates next year. And also then with the revised dot plots, the Fed is basically saying if you have stronger growth this year and next, that then increases the risk that core inflation does not fall as much as Fed officials hope and expect. And that essentially means there is the potential need to keep nominal interest rates higher than previously forecast. That's basically what this narrative is saying in a nutshell. That seems plausible, of course, but for us then another hike is slightly more questionable, certainly this year. And what we're seeing really is tightening financial conditions. That is key. That means higher borrowing costs, higher mortgage costs, less credit availability. Plus then, of course, there are other near-term headwinds in play, like the government's shutdown, although possibly that's going to be potentially more positive potentially now. And then we also have, of course, the Detroit 3, the UAW strike, as well as then the restarting of student loan repayments. And remember that ultimately the Fed is still data dependent, and potentially these growth and unemployment forecasts that we're seeing are too optimistic if then these tightening financial conditions do start to impact the economy and some of that resilience that we've seen. I think one economist on Wall Street called it Goldilocks without the bears, and that's sort of pointing to potentially downturn or in the series of data that we're getting, which is what is certainly will be needed to turn around, reverse potentially this dollar relentless rally that we, of course, have been seeing 10 consecutive weeks and counting for gains in the DXY. We'll look at the DXY shortly when we look at US core PCE actually. But firstly, or next, let's just go to the Bank of England. Let's just check you can see that. So initially, well, we had the UK CPI report, which surprised to the downside. You can see the figures here. So the headline fell to 6.7% from a 7% increase actually, with disinflation, so falling prices being seen across a range of categories. So really interesting, surprise downside miss in UK CPI, and especially in the core. That is, as we say here, it excludes more volatile food and energy costs, really seen as a better gauge, a better measure for underlying price pressures, and that fell sharply to 6.2% below the expected 6.8 and below the previous 6.9. So really welcome in a way downside surprise for UK CPI, and that was obviously the day before the MPC, the Bank of England meeting, which really put the cat amongst the pigeons, if you like, because a rate hike was expected, was priced in really. Close call, but pretty much was priced in 60-40 really, I think, before the decision. But then after those soft inflation numbers, then those odds turned pretty much the other way, slightly, pretty much or so before the decision. So the Bank of England, they kept rates unchanged at 5.25%. Forward guidance remained broadly unchanged as well. As I said, the vote was split, so 5 members voted for an unchanged decision, 4 for an increase of 25 basis points. The majority really cited the downside surprise, of course, in that August inflation data. That's why we've highlighted it here, of course, and also then further signs that the labour market was loosening. The bank also expects then GDP to rise only slightly in the third quarter of this year, and underlying growth in the second half of this year also likely to be weaker than expected. Likewise, the MPC expects CPI inflation to fall significantly further, quoting them there, while noting that services inflation is projected to remain elevated in the near term. And I have got that here just to point out that that also fell down to 6.8%, so below the MPC forecasts, although, as I've said, they did mention that it's projected to remain elevated in the short term at least. The BOE then reiterated that current monetary policy stance is restrictive, and that the monetary policy will need to be sufficiently restrictive for sufficiently long to return inflation to 2% target sustainably in the medium term. So that's probably key, this sufficiently restrictive for sufficiently long, and that sort of tallies with other central banks like the ECB, of course, saying similar kind of phrases and words, and it's really then how long this sort of lagged effect of all these rate rises that we're seeing will start to then impact the economy more quickly, and and then whether then we get the pricing of rate cuts, of course, which we're getting because higher rates are no longer needed to be sufficiently restrictive for that sufficiently long time. As I said, the Bank of England, they retained its forward guidance. Further tightening in policy would be required if there were evidence of more persistent inflationary pressures. Remember, persistence is key for the Bank of England. So that kind of says that the potential for a hike further out is potentially there still, and of course that is amplified by that tight vote split, of course, with 4 members voting for a rate hike. But against that, we think is key is obviously the data going forward. Indeed, if inflation levels off, if we've seen this peak in private sector wage growth, which is key for the Bank of England, then certainly data releases going forward, as with all central banks, will be key for the Bank of England. We note they are rather limited before the next meeting on the 2nd of November, so we only get one more jobs report, one more wage data report, that is, and then also only one more CPI report for September before that November 2nd meeting. And really you have to think then, for us especially, they would probably need a massive or a really big upside surprise to that data really to change then the MPC's views of pausing really and changing that to a hike. Otherwise, I think it's interesting as well, a hold is then also then potentially on the cards, and that potentially also means the end of the UK tightening cycle. So then the markets will shift to rate cuts, as I say. Also interesting to note that one of the MPC members, John Cunliffe, who voted for a hike, he is leaving the MPC, and markets slightly unsure whether his successor, that is Sarah Breeden, will vote the same way. And many, I think, have speculated that she won't want to rock the boat too much and will go with consensus, which means a pause at that November meeting. We shall see. Markets kind of agree. It's probably the end. They only price in a 25% chance. Probably less than that now, actually 20%, probably around that for a November hike, with a coin toss probably less than that now as well for a hike by December. Okay, just bear with me and I'll just pull up the cable chart, which is obviously key and looking depressing for any sterling holders. Which you can see here. I just wanted to touch as well on some of that data as well, which is critical for the UK. We did have PMI data on Friday, which was grim. So services, especially services, moved down to 47.2 from 49.5. That was lower than expected. Really now the survey showing employment as well falling at the fastest rate since October 09, excluding lockdown volatility. That kind of all means that domestic generated inflation is again likely to slow in the coming months, and that then would push services CPI lower as well, which as I've said is key for the MPC. They apparently did have a sneak look at that data, which is interesting to some of us, but it certainly vindicated the decision to keep rates on hold, and really the survey data leading indicator really points to deeper downside risk for the UK economy in the third quarter. Okay, for cable then you can see just well, interesting. We pointed out this descending bear channel series of lower lows, lower highs over the last few months since that July high above 131. We're now sort of down below 122, but interestingly, kind of outside this bearish channel. We've dipped outside it before and consolidated before dropping lower. So in a way, you can see the RSI is deeply oversold as well. Consecutive days of losses. We don't get those often, and if we look at the weekly, I know there has been that that 1 or 2 weeks of gains, but they were very marginal, especially the end of August gain. So 4 weeks of losses. We haven't seen greater than that. You can see going back to probably where are we? Yeah, December 2018, it looks like, for 5 consecutive losses. Just bear with me. I'm just checking this out, actually. What have we got here? 1, 2, 3, 4. Yeah, so you've got to go back a few years to get 5 consecutive weeks of losses in cable. Looks like we are heading that way at the moment, or not. 1, 2, 3, 4. We're only on 4 at the moment. Apologies. So yes, just watch out for this. We are watching it closely as well. Whether there's a rebound, we can't see a catalyst at the moment, fundamental catalyst, but technically you could see some consolidation. Tough to call it at the moment, obviously, with this long-term trend, dollar bull trend, of course, but certainly you might think we want to get to round numbers. So 121 is next. And then you've got this sort of minor fib level just below 121 and 120.89. That is cable. I think also we'll just point out euro sterling getting to a point I have noticed on the chart and been trading. This base sort of developed around the previous, well, December low there, December from last year, that is, around, where were we? Around 85.55. You can see that sort of held more downside in euro sterling, so a base developing quite nicely, and then we pushed up now to the 200-day moving average. That's at 87.08, which kind of tallies with these mid-July lows, highs, sorry, at 87, around there. So interesting. That looks like bullish consolidation to us. If we do break higher, push above 87.08, then we do have, yeah, this high here, the June high 87.21, which had held, you can see, prices before then breaking lower. So that could be a level of resistance, a zone of resistance for euro sterling. But for us, that kind of looks like bullish consolidation. If we can get above here, then we're up towards 87.50 or so. That is euro sterling, which we don't look at that much, but I thought we should do because it's getting to an interesting point. Okay, let's now move on to, let's finally look at the Bank of Japan meeting. Just quickly, they obviously kept unanimously decided to keep rates and its policy settings unchanged last Friday. The result, a bit of a disappointment given there wasn't any clear sign of a policy shift from its statement or from Governor Ueda's comments. The Bank of Japan statement maintained basically most of the wording from before, kept its forward guidance unchanged. Firmer than expected inflation really is not enough for the Bank of Japan to tilt its policy stance. It basically still believes it's those inflation numbers are transitory. And interesting that the recent inflation data show price pressures to be more stable and sticky than expected. I think the headline rose to 3.2 versus 3% expected. Core stayed at 4.3% for a second month, so still sticky. But going forward, we do get updated forecasts from the Bank of Japan at its next meeting in October. So there is speculation that we possibly get another yield curve control policy tweak then, with possibly a rate hike coming, well, next year, really into the second quarter. But we kind of think Bank of Japan is being cautious, is being steady around any, well, policy tweaks, of course, but then any rate hike is some way off still. That hike really, it would need to see signs that solid wage growth have been sustained for a prolonged period. As for dollar yen, well, at the moment, it's toying with sort of 150 now. We are in sort of intervention territory, of course. If we just go back to the weekly, you can see where we had intervention previously, last sort of October, so around a year ago. We had or did have Japanese Finance Minister Suzuki on the wires yesterday, I think, weighing in on the currency. Basically said he's watching FX moves with a great sense of urgency. Hasn't put off dollar buying really against the yen, and that is what we've seen since, of course, that this week really, since the hawkish Fed decision, contrasting, of course, with the Bank of Japan decision a couple of days later. You kind of think now then real intervention from the Japanese authorities is likely not far away if this pair continues its upward trend that we've seen in the past couple of weeks, of course, with policy rates reached or at least getting close to that stage in G10 currencies. Generally then, we kind of would expect relative rates to be yen positive from here. And as well, from a historical perspective, interestingly, a global environment with declining growth and declining inflation tends to favor the yen. So potentially look out for those, as well as, of course, intervention. That battles, of course, with these rising treasury yields, which this pair highly correlates to the 10-year treasury yield. Don't forget that. So we shall see what happens from here. Japanese authorities, as we say, probably likely to intervene with physical intervention, and that would, in case, or then see, of course, this major tumble. Support levels, you've got the 50-day moving average way below at 145.31, that blue line. You've got the breakout level around 148.36 or so, just above. That's near-term sort of support, but potentially they would probably want to move down towards, these previous highs of 146.67, and then, as I say, around 145 or so potentially. But that will be tough as long as 10-year treasury yields are still rising. Okay, let's go now to the data for this week. Firstly, we get US PCE inflation data. You can see the chart here, likely to fall, but supports this higher for longer view still. Analysts expect core PCE prices to rise by 0.2% month on month in August. That's matching the rate seen in July. Traders, of course, will all be framing the data within the context of Fed policy to judge whether the central bank will follow through on its projection of another rate hike this year. Just going back, they raised their PCE projections for this year from 3.2 to 3.3%, I think I mentioned, versus the 3.3% printed in July. But then they lowered its core PCE outlook to 3.7. I did mention this, from 3.9%, and that's versus 4.2% in the July data. Powell, certainly he was encouraged by the last three inflation reports, but he said he did, of course, want to see more than just three decent readings. Let's now, so that's core PCE data. We'll just quickly go to the DXY chart. This is obviously the dollar against 6 of its major trading partners, with the euro having by far the biggest weighting, about 56, 57% or so in this weighting. So just remember that. 6.7% now is the rise from those July lows. And if we just go to the weekly, let's get rid of that. You can see now, yeah, 11 went to the 11th consecutive week of gains. That is exceptionally rare. But we're not overbought on the weekly RSI. You can see we are overbought now on the daily RSI, 74.65, sort of 70 and above denotes being overbought in extended territory. Doesn't mean we can't go further, of course, but possibly we get a sort of pullback. Otherwise, you've got the halfway point of this decline being at 107.17, and I think the November highs are around or just below 107. So that will be a target for bulls, of course, to sustaining this relentless run. The dollar really being a kind of wrecking ball to other currencies at the moment. Also, of course, we do get, just bear with me, Euro zone inflation data. And there's a chart, excuse me, here, where we are falling, of course, but whether this is fast enough to keep the ECB on pause is a big question. Consensus sees the headline inflation declining 0.6 basis points to 4.6% year on year. That would be the lowest rate since October 2021. More importantly, core inflation is forecast to moderate 4 pips to an 11-month low at 4.9% year on year. Headline inflation, just going back, that will take a notable step down, not least because of base effects associated with last year's heavily discounted German travel pass, which now falls out of the calculation. And then base effects related to last year's energy and food price shocks will more than offset then the impact of the further rise in the price of auto fuel. Ahead of this release, the preliminary inflation estimates from Germany, Spain, Belgium, they're released tomorrow as well, so look out for those. For the ECB, probably the release will be unlikely to have a major impact on pricing for the October meeting. That assigns around a 90% chance that the deposit rate is held at 4%. Of course, if the release comes in below expectations, and given Friday's soft September PMI data, which we saw, the markets could begin to bring forward expectations of ECB rate cuts. And I think the first 25 basis point reduction is currently priced in around July next year. As for the euro, just bear with me 1 second and I'll just pull up that chart, which we haven't looked at just yet, which is here. Well, positioning firstly for euro dollar net long scaled back further actually in the recent reports, fell below 15% actually of open interest. That was the first time since October last year in the week leading up to the Fed meeting. Certainly then hawkish Fed and ongoing weak euro data probably likely prompted speculative positions really to keep unwinding those net long euro positions. And then we've seen this, obviously, this long-term bear trend, again, descending channel, popped out of it, but then back into it. Now we're falling again. We broke down through that May low 106.35 that we had our eye on. Then a sort of big fib level around 106.11. Just checking. Well, 106.10. Yeah. Which is a long-term fib level and a near-term one as well, around 106. So broken down through that. So now we're up down to potentially these sort of March lows, which are around 105.20 and below. So that is next major support for the euro, but not looking good at the moment. Okay, that is all we have time for now. Please do check in with us next week. Actually, I was just checking. Next week is our next webinar because we missed out on last week. So our next webinar is next week on the 4th of October. Just checking the date. So please do come back to us then. Hopefully that's proved of use to you guys, and we will speak to you then. Take care.